Can everybody hear me okay? Just want to confirm with a yes or no if you can hear me. We're gonna do a deep dive in gold. I get a lot of people asking me all the time, what's your opinion on gold? Is it gonna rally? Is it gonna drop? Where's it gonna go? So I'm gonna give you a little bit of inside look at our Sherlock analysis process that we use every single day in order to determine what's going on in the markets. I should close that off. There we go. There we go. Close off a couple things. Good. You guys can hear me fine? Good. Very good. So we're going to use the Sherlock analysis process to discover what is taking place with price, because as I've mentioned several times, you can't rely on the media, you can't rely on analysts, you can't rely on anybody to give you the actual information, the true information of what's really taking place with price. The only way you're going to figure that out is if you do the analysis yourself. So that entails you know what to look for on the charts. You know how to examine raw data. You know how to put it all together and figure out what context price is currently in. And when you can do that, then you can do extremely well. All right. So we're going to start by taking a look at a higher time frame chart here. Here's a weekly chart of gold. And so I want to first point out that, you know, this was all-time highs here at the 2000 area, okay? And we're going to take a look at, and what date was that? That was back in August 2020, okay? August 2020. So I've collected all the CFTC data going back to the beginning of when they started collecting data, okay? So in order to understand where price is, you have to understand the story, okay? You have to understand gold's story. You have to understand its past, where it came from, where, you know, things have been in the last couple years, so that you understand where price is now in the context of the greater storyline, okay? So we've got this massive rally here that we see gold did here back in 2020, okay? Do you remember that? What happened there? Okay, this was the COVID rally, okay? This is the COVID rally. Beginning of 2020, big strong rally up. So the peak of this rally is August 2020, all right? So when we look at the CFTC report, what we will see is, and let me do red. Red should be good. What we can see is August 2020, if we scroll down a little bit more, August 2000, July, right here, okay? As you can see, oh, that's way too big. Back in August 2020, I'll just show you this data here, okay? August, all right? When you look at that, what do you see? Okay, you see a column for longs, right? And you see a column for shorts. That's the long column. That's the short column. And when you look at longs, you can see they were in the low 300,000s, okay? Low 300,000s. What about shorts? 80, 78, okay? So they're very low. So in comparison, long positions were a lot more aggressive than short positions, okay? Now, if you use the conventional wisdom that you should be paying attention to commercials, which is this group over here, let's take a look at what the commercials were doing with their positions. They were mostly short. Now, does it make sense to pay attention more to the commercials when after such a massive rally, they were short as opposed to long? Who's moving the market here? Is it the commercials who are going short gold? Or is it the non-commercials who are going long gold? Okay? The markets move up because there's buying and selling that's taking place on the charts. So the markets move up because there's significant buying taking place, which means long positions are being opened up. That's why price moves up. So for anybody to tell you that you should be paying attention to commercials, the only data that you would be seeing is that there's a larger percentage of short positions than there are long. But what is the reasoning? You know, the reasoning that they give you, they try so hard to make it make sense. But when you understand CoT data and you understand how price action actually moves and why it moves, you understand it's complete nonsense. Okay. What they're trying to tell you. Okay. Let me just do a little screenshot here because I want to save this chart. Let me tell you and show you what they're trying to convince you of, okay? I really want you to, understand this. Somehow I opened up my thing. Let's do this again. I really want you to understand this, okay? There. Let me just put that aside here. And I'm going to close that. What they're trying to convince you of, ladies and gentlemen, is that as price was rallying higher and higher prices, and as the commercials kept on adding short, what they're trying to convince you is that, see, the commercials are the biggest player. They are the biggest player. And they were preparing for the drop in gold by adding short and adding short and adding short as price was rallying. So it's not that they're wrong, it's that they're typically early. Okay? They're typically early. Let me ask you a question. What does that type of behavior remind you of? Doesn't it remind you of your typical trader? Your typical trader, that's what they do. Okay? They're getting long at the wrong point, or they're getting short at the wrong point. Okay? If you're getting short the market here and then it rallies up higher and you get short and it rallies up higher and you get short and over and over, you know what ends up happening? You blow your account up. Okay? But they're trying to convince you that this is what the commercial side is doing. They keep on adding short because they're early. All right? So you should look at the extremes of their positions as a signal to get in. Well, the thing is, if you're not collecting all the historical data and doing spreadsheets like we are, and tracking what, the extremes mean, and what are they, what numbers are they, if you're not tracking that, then you don't know what the extreme is. Because the way that they present the data to you online, they're not showing you these are the extremes. They're not explaining to you what extremes are. You apparently are supposed to have figured this all out. But the thing is, nobody's doing that. Instead, what's happening is traders are looking at the commercials, and what they're seeing is that, they're getting in mostly short. Okay? As price is rallying up. All right? So if you thought, oh, they're getting in short, I should get in short, guess what? You're going to end up blowing your account because price is going to continue going higher and higher. Meanwhile, you should have been paying attention to the non-commercials, because as they were aggressively starting to accumulate long positions, that is what caused price to rally up. And that's why we track both. We track both because we look at the commercials as a contrarian indicator, okay? So we combine what the commercials are doing with the non-commercials, but we flip. In essence, we flip what the commercials are doing upside down so that it relates to what we really need to understand. Okay, so when I look at net positions here, I'm looking at, see the difference right here, the difference right here. I'm looking at the total here, and I'm adding the total here. Looking at net positions and what that combined equals, okay? That's what I'm doing. Combined, what does it equal? All right? How long or how short are they? And because I look at their shorts as longs, and I look at the longs as shorts, this total gives me a better indication of what's taking place. Considering that commercials, they're hedging, okay? The commercial side knows that price is rallying up, but they're opening up shorts on purpose, for their own reasons. And there's a ton of different reasons why they would do that. But the commercials are always hedging their positions, okay? That you have to understand. That's so imperative that you understand that, okay? All right, so so this is what was taking place here as this price was rallying, okay? So it gets to the highs. What do you think typically happens when, you know, price reaches the highs and it's not going to go any higher? They typically take profits on their positions, okay? So they reached the most aggressive at January 5th, 349,000 longs, January 5th. And that is what date? 2021. Oops, sorry. Let me double check that again. January 5th, 2021. So where's January 5th, 2021? Right here. Right there. Right here. So let me just do something so you can see here. Look. So all of this here, they are massively long. So let's put this in green. Like that. Massively long. Yeah, because they accumulated those positions from down below. Okay? So what's going to happen is that they're going to require, if they're going to get out of their positions, they need to sell off their positions, which means they need people to buy it at those highs. And they'll always find reasons to lure people in to buy at those highs. Recently, at the beginning of 2022, it was the Russian attack of Ukraine, okay? Oh, we're entering into war. We should buy gold. Because all the textbooks tell you to do that. That's the safe haven. Buy gold. Uncertainties in the world. That was the excuse that they used up here. And what do you think the traders, the non-commercial banks, investment companies, what do you think they were at that point? Okay, it's no different. Beginning of February, January, February 2022. Let's take a look at the data. Because I think you'll find this extremely interesting, and it'll give you more insight as to how things work. Okay, so they were massively long back in 2020. Then we saw them take some profits, which caused price to drop. Okay, you see how the numbers are being reduced here. Okay, the shorts were never that much aggressive all throughout this stage. Okay, if you look at the coloration of these cells, the more red and the darker red, that means the more aggressive they were with their positions. The more white or the more blue, the more neutral, okay, or average size. Or not average size, but more neutral, not very concentrated on those positions at all. Okay, so as we move throughout 2021, what do we see? You know, neutral, right here at the beginning of February, neutral positions. They're not focusing on shorting gold at this point. Even April 27th, we have 270,000 long, and we only have 100,000 short. So again, nothing very aggressive. All right, and as you can see, price was just sitting like this on a range up at this high for quite some time. Okay, that's what was taking place. So let's go back here and take a look. We'll move through 2021, entering into the summer, August 2021. Now I want to bring your attention to what we see here, August 24th. Okay, right here. I want you to see how all of a sudden there's a bump up in long positions from 284,000 to 299,000. August 24th, okay, that's 2021. So August 24th, 2021 is right there. Okay? This area here. Okay? So they took profits. You see what happens when they take profits? You see the decline? Okay? Nothing serious with respect to shorts. Do you see price drop down here? No. Why? Because they weren't adding shorts. Now, the next time they start to get serious about adding longs, right down here. And let's take a look at the data and see what ends up happening. 299,000. Take a look. 311,000. 306. 306. What are shorts doing? Nothing. Okay? Slightly red, but nothing really important going on there. 306, 296, 293, 295. Now we're bouncing back up again. Now you're asking yourself, why are they going from 194,000 to 125,000 here? Well, you have to understand that when you have them increasing shorts, what they're doing is, you see, when you have these rallies like this, right, they're accumulating longs here. And you see what their accumulation of longs does on the chart? It rallies price up. And when retail traders see big rallies like that up in price, they get excited. And so if you take a look at the sentiment of what retail traders are doing in cases like that, they're thinking, oh, price is heading higher, so I should probably start buying because it looks like it's going to start going much higher, just surpass the previous highs and so forth. So what the banks will do is they'll come in and start shorting it and pushing price down to shake off those retail longs. Then when it gets down here, they'll start reaccumulating. Okay? They'll start adding back into their long positions. Right? So that's what happens. That's why you're seeing positions like that. Okay? The big increase. But you see, after they lure them in long and they drop price and they shake them out, look what happens to short positions. They close them off again. Thank you very much. We don't need your services anymore. We can close off our shorts and continue on pushing price upwards. Why? Because they're increasing long positions. Okay? What are the commercials doing? Getting in short, majorly. Okay? So is that what you should be doing? Should you be focusing on the commercials? Maybe you should be getting in short too, right? That's not going to work out for you, because look what ends up happening with price. It ends up going a lot higher. So let's continue. Look, November 16. Look at that. They went from October 26 to November 16. Look how aggressive they got with their positions. Okay? October 26, 2021. October 26, right here. Aggressive. Right here. Okay? Then we have the rally up. Price comes back down to those areas where they're accumulating, and then it shoots back up. All right? So this is the beginning of the big move to the upside that we end up seeing. To here. Okay? This is the beginning. Now this is in November. Amazing. Amazing how they accumulate gold from 1700s. 1700s. Up above 2000s. A mere, what, 3 months before the war? It's unbelievable. Their ability to know what's about to happen, eh? Or what luck. Isn't that just such incredible luck? Amazing luck. Wow. Wonderful. 360,000, okay? After price moves up, they take profits, push price down like we were talking about. Now, look, back on February 24th was when the media told everybody, hey, guess what? There's a war, buy gold. Okay? And on February 22nd, 2 days before it was reported in the news, look what their long positions in gold were. Okay? 350,000. And that was up from 313. So a massive spike up in long positions between February 15th and February 22nd. So February 15th is here. This area here. Okay? This is before it was reported in the news. Now remember, companies like Vanguard, BlackRock, those investment companies that have massive banking cartel funds that control those companies, they are the ones that also control all the media companies. So they are the ones that own the banks. So if you're going to be releasing information in the media regarding a war, isn't it interesting how you would position yourself very well leading up into that news being released? Because that's exactly what they did. You know, when they talk about insider trading and they're like, well, we have, you know, investigative groups that go out and investigate different companies to make sure that there's no insider trading. They are insider trading, okay? They are the very definition of insider trading. They control all aspects of the game. The media releasing the information, when the media releases the information. But I don't think that they just get intelligence that, you know, Putin's about to do something, and then so, you know, they figured, oh, let's just hold that information until there's an actual strike. Like, how do they know when that strike was going to happen? Okay, they're moving their military into place and they kind of have an idea of when the strike is going to happen. But this was the setup for this was 3 months prior, 4 months prior. Okay, why didn't they drop price all throughout this here? Why didn't they drop price all throughout here? Why didn't they do that? Why did it hold this area up here the whole time? So it's hard to say exactly what's going on and how much information they're using. Obviously, they're tapped into intelligence information to gather information about what's happening in the world and using that information for their positioning in the markets. It's obvious. I mean, the CFTC data is telling us that. Nowhere can you know for a fact what's going on, just like looking at the CFTC data and understanding. But again, if you were looking at non-commercials, you wouldn't see the parallel between the information when it's released and what the banks were doing leading up to that information being released. You wouldn't see it. You'd be like, oh, the commercials, they were adding short at these highs. They didn't know. Why would they be adding short if a war was about to happen? I mean, they didn't know that there was going to be a war, because wouldn't they be going long if they actually thought there was going to be a war? Like, you see how it keeps you off. It keeps you off the track of realizing what's really going on. Okay? Very conveniently, that information is given to you like that, so that you cannot track what's really going on. All right. So leading into March, look, March 8th, 364,000, because after they released the news and they told you that there was an attack, okay, they came in and bought some more to help fuel the move to the upside, to get everybody excited. That fear of missing out. Oh my gosh, there's a war. And look, gold is actually going up. And do you remember all the major banks came out with predictions of where gold was going? 2,500. I remember that. Do you guys remember that? I know people nowadays have very short memories. That's why I keep very detailed notes of all this stuff, so I can track the story. Because when you track the story like an investigator, you see exactly what's happening. You see what they're doing, how they get away with it, and how easily people just forget and forgive. It's amazing. So the big bangs came out, 2,500, gold is going to 2,500. And guess what everybody was doing? Buying gold. And what do you think the banks were doing? You see this drop? Look, from 350, look. It right into May, they dropped it to 282,000. That's aggressive. That's super aggressive. They offloaded a heck of a lot of long positions, and guess who was buying them? Everybody that was watching the news and listening to what all the big banks' estimates were. So you see what's going on here. You see the correlation between what's happening in the world, the information that they have, when they release it in the media, how it's released conveniently at very specific times after they have already positioned themselves. So, I mean, it's like, do you want to know what's going to happen in the future? Just track the CFTC data and see what they're doing. Just track their positions and track the movements on the charts. And you'll know before anybody what is going to happen, okay? Because you could see them prepare for it before the news comes out. Right now, the big thing is, inflation. We've peaked inflation. Like, you just have to watch the news a little bit. And you see exactly what they're doing, what they're saying, okay? And once you know how the game is played, you already know why they're saying what they're saying. So you can already predict what's going to happen in the markets before it happens. 6 months from now, when the markets have tanked majorly, everybody's going to say, oh, could you have seen that coming? No, we couldn't have seen that coming. I mean, inflation peaked. The key indicators were telling us that it was peaking and that, there should have been a shift to the downside. So logically, there should have been, the market should have rallied up. And so they're going to come out with all these explanations as to why it didn't end up going up. But we can come to those conclusions now based on what the institutions are doing with their positions, based on what the media is reporting, because the media is suggesting one thing while the institutions are doing something different. Just like here on gold, the media was suggesting something while the institutions were doing the exact opposite. Okay? So this is taking us into May 2022, earlier this year. Okay, so where do we go from here? Well, let's move forward. So you can see all throughout 2022, it's all been about taking profits on their long positions. That's what their focus has been this whole time, taking profits on their long positions. And then in mid-June, they started adding a little bit more to their shorts. Okay, mid-June. And that takes us into down here. Okay, and I got in short. Why did I get in short? Well, because they were adding short. That's why. That's the simple answer. I got in short because they were short. That's why. And I saw a good opportunity for a drop because we were looking at several indicators of what was taking place on the charts, how institutional areas were being reacted to, and what the media was saying, and it was just pretty clear to us, they're going to drop price. So I got into some short positions through selling call options on GLD and profited very well with them until price got down here. Okay, price got down here. So let's take a look at what's going on right now with the positions. So as you can see, as I move throughout July, you see how aggressive now short positions are, okay? But, one really important thing that I want to point out is if we take a look at just the numbers, long positions are 241,000. So anybody just looking at the raw data would say, well, long positions are 241,000 and shorts are 148,000. So they're more long than they are short. Right. But you're not putting it into context. Based on what the positions were a week ago, 2 weeks ago, 3 weeks ago, 4 weeks ago, even though 241,000 is a larger number than 148. You see how the coloration of the cells tell you a different story? You see how longs, the coloration of the cells are a light red? That means they're not nearly as aggressive as what they used to be. Okay? Putting that in the correct context, you understand that they're profit taking. When you look at short positions, you can see that the coloration has been getting a lot more red as price, okay, as it's been going throughout the dates, June all the way to July. Getting darker and darker. Why? They're accumulating a short position. And interesting enough, as they're accumulating a short position, what do you think gold is doing? Dropping. Okay? Dropping. All throughout the summer, gold dropped. That's what it did. Okay? They were accumulating a short all throughout here. And then price dropped with their shorts. That's how we got down here with price, by the way. That's how we got there, is through their shorts. Okay, so let's move forward and see what's going on now. All right. So, August, they started taking profits on their shorts. You see that? Look at the numbers. Look at the coloration of the cells. You see how they went from dark red to now lighter red? Profit taking on shorts. Why would they profit take on shorts? Well, you see recently what's been taking place in the markets. So as price comes down to the lows, they profit take on their shorts. Why? Because they were preparing for this move to the upside. That's why. Okay? Preparing for the move to the upside. And now we move a little bit forward. We see they added a little bit more shorts. What was happening here, because we were tracking the sentiment from retail traders, and retail traders, every time they got in long, the banks shook them out and pushed price down. When the retail traders got in short, the banks pushed price up and shake them out. It was like, you know, every time they got in, they'd shake them, until the retail traders were so aggressive to one direction, either short or long. At the lows, they got them to be very aggressive short, okay? And when they got them to be very aggressively short down here, then they propelled price to the upside, okay? Because when the retail traders are aggressively short, how do you think they're aggressively short? It's because somebody else is aggressively long, okay? So they got in aggressively long, and lo and behold, price starts to rally up. So remember, the rally, we can track it October 31st. So let's move upwards. September, October. See the increase from the lows in long positions. Now here we are, November 8th. So I want to point out something. As price was rallying up all throughout here, look what's been happening with short positions. Okay? Look what's been happening with short. 127, 118, okay? And then 133, 144, 151. Shorts are aggressive right now as price is rallying up. Why do you think shorts are aggressive as they're rallying up here? What could be the reason why they would rally price up and get into short positions? Well, I could tell you a couple things. One of the things could be because, let's take a look at retails. Okay. Look, as price was going up. Retail traders have just been shorting as price has been going up. What do you think they're going to do at this point? Because we're tracking the buying and selling taking place from the banks, and I can tell you that right here in this spot right here, this is a major selling area by the banks, okay? Major selling area by the banks. Have we actually hit that area? No, we haven't. Okay, but I know for a fact that the banks were selling gold right here on higher time frames, meaning they were aggressively accumulating a large short position up here. And the CFTC data is supporting that. Okay. So as price is going up, look, this is the wrong thing. They got them aggressively short. And when you're so aggressively short and price starts to go against you, you feel like you don't have any other choice but to double down, right? Because again, what are the commercials doing, right? Commercials are probably adding short as price is rallying up too. Yeah, commercials are larger with short positions than longs. So they're probably figuring, well, if I just follow what the commercials do, I should be good. Yeah, well, you don't have the resources of money that the commercial side does, because they're just playing monopoly money here, you know? They just open up positions and they use their positions in order to hedge themselves in the real markets and in order to move the markets. So retail is very short. They're going to end up shaking them out. Okay. Whether that be from another rally up in price or some manipulation of price here at these highs, something is going to happen. Okay. But the main focus here is that when you take a look at short positions right now, they are aggressive. Okay. See the coloration? Aggressive. Longs are big only because they needed to add some long positions to cause price to rally up. But the ones that the position that we should really be focusing on here is shorts, because they are the aggressive one. Okay, so what does that tell us when we're putting the pieces of the puzzle together and we're trying to figure out what does this data tell us? Well, we follow the storyline, right? You know now, because I just told you the story of how the banks enter into positions before moves take place. All right? So if you see them aggressively adding to their short positions as price rallies up, it's probably that they're preparing for something, okay? Because there's a difference between price rallying up here and the banks adding longs, and price rallying up here and the banks adding shorts. Okay, do you know what the difference is? The difference is all throughout here, the storyline was about accumulating a long position. Okay, that's the story. Accumulating a long position to take profits here. That's the story here, okay? And then that same story was copied here. That's the storyline. Now, this last move from 2022 has been a completely different story. This storyline is about getting in shorts and taking profits on shorts. So rallies now are within a different context. Rallies now are not a sign of strength. Rallies are being used to accumulate more short positions. Because what would you rather have? A short position from 1640 or a short position from 1770? Okay. The only thing now is they have to tell a story that's different from their story. So when they're bearish, they have to sell you a narrative of gold being bullish. When they're bullish, they have to sell you a narrative of gold being bearish. When they need to offload their longs, they have to sell you a narrative that gold is going to be bullish. When they need to offload their shorts, they need to sell you a narrative of gold being bearish. So this is how it works. So if you want a full picture of what's happening in gold, you got to track what's happening on the charts. Take a look at their buying and selling and how they're moving price on the charts. Understand the context that we're in. Look at the CFTC data, track its history, and follow the storyline so you have a clear indication of what's taking place. Once you understand, if you've been tracking the storyline for years like I have been, it's a movie, okay? And you learn about the characters. You learn about these characters. It's like when you watch a TV show, right? When you're into your first season, you don't really know the characters that well. You don't know how they're going to react to certain situations. But by the third season, you're like, oh, Mary, man, he ain't going to put up with that. You already know what she's going to put up with and what she's not going to put up with. You already can see what's going to happen with some of these characters, right? So following the storyline of price, it's like following a multi-season show, television show, okay? A series. And the more years you've been following the movie line, the storyline, or the movie, or the series, the more you become aware of the storyline, how it's played, the characters, how they play, the situations. You know, there's only so many situations that take place in the markets, right? Accumulation, distribution, distribution. And they take place on multiple time frames. So if they're taking place on a higher time frame, that means they need more time to accumulate. That means the narrative has to go on for a lot longer, okay? If they're accumulating something on a shorter time frame, let's say daily chart, weekly chart, then the narrative only has to be short term. So depending on how long they need the narrative to ride for, they use different methodologies to sell these narratives. It's very brilliant. It's just incredibly brilliant how it's done. But it becomes very clear once you've been doing this for long enough. Okay? Very clear. So again, last words on this before I let you guys go. They're accumulating a short on the rally. Okay? They're accumulating a short on the rally. Now, if gold drops, what do you think is going to happen with the dollar? Okay? And do you not see the narrative of the dollar peaking, the dollar peaking, the dollar peaking? You see it everywhere. All the experts are saying that the dollar's peaking and that we're going to be getting a drop in the dollar. Well, okay. Maybe. I wouldn't put my money on that, because when you follow the narrative here, we just went through a 2-year phase of bullishness, offloading long positions, bullishness, leading into the war, offloading long positions, and now bearishness. Okay? And we're in the middle of that accumulation of shorts. So you think the dollar has peaked? I mean, they could tell you whatever they want to tell you. What I'm telling you is trust the analysis, trust the evidence, trust the storyline, because they're betting that you're not going to do the work. They're betting that you're not going to see the storyline, that you're not going to be aware of this mini series, okay, that goes on. They're hoping that you're not going to realize that there's a story here that plays out year after year after year, and we're in season, God knows how many seasons this has been going on for. You know, from the beginning of the markets, I mean, I've been reading a book about the history of the markets. It goes back to the 1600s, okay? The 1600s. So we're in season, 20, 30, 40, 50, 60, 100. I mean, how many seasons has there been? So you understand why they say the markets are random? Because if it was random, would there be a movie? Would there be a series? Would we be in season 3, 4, 5, 6, 7? No. Whatever series you're in, it depends on when you start doing this analysis. You start doing this analysis today, you're in season 1. Okay? Those students that joined us and have been tracking this, some have been with us for 3 years, they're in season 3. It depends. But the longer you've been doing this, the more versed you are in the methodologies that are being used and the characters and the roles they play and how this always works. You start to become extremely aware of what's going on, and then it becomes, it's not very difficult to determine what's going to take place in the markets. All you have to do is do your work, do the analysis, collect the evidence, and it becomes pretty evident what's going on. Okay? We only spent, 42 minutes going through this. Has this been helpful for you in understanding where we are with gold? Does it make sense what I am laying out for you? Do you see what I'm talking about? Do you see what's happening here? Okay? You understand the somebody writing here. Do you understand the storyline here? Because this is very important. Okay. Once you understand the storyline, then you can make better, more informed trading decisions. Okay. Ones that are not going to hurt your portfolio, but actually help your portfolio. So once you understand the context of where price is and where we are right now, then you know, is it a good idea for you to engage in the market or maybe not? And if it is a good idea for you to engage in the market, where would you like to see price? What would you like to see in the news? Okay? These are the kind of things that you'll start asking yourself. And then when you know it's the right time for you to get involved, then you get involved. But you do what the banks do. Not what they tell you you should do on TV. Not what the so-called experts and the talking heads on all the other main broadcasting stations, what they suggest. You don't listen to them. You listen to what the evidence is telling you. And then you can't go wrong. Okay? Well, if you go wrong, it's because your interpretation of the information is not as accurate as it should be. And if you're in season 1, you know, you're not going to know exactly how things are going to roll. But once you get to season 2, 3, 4, you start to see the same things repeat, and it starts to become predictable what the reactions are going to be like. Okay? So I'll leave you with that. I hope you guys enjoyed today's session. It was nice chatting with you guys. And if you haven't gotten to our Telegram channel, you should. I post a lot of information on there. Just go to whiteoakfx.com. If you scroll to the bottom of the page, you will see a link for our Telegram channel. So join us in there. There's a lot of information there. Plus, there's a link at the bottom of whiteoakfx.com where you can sign up for a newsletter. I haven't been sending out a lot of newsletters over the last month because I've just been so busy. We've had so many students join, so many members. It's just incredible how quickly the school is picking up in speed. And I'm honored to see that you guys see the value in what we have to offer here. So join the newsletter, join us on Telegram, and hope to be of some service to you guys. All right, that's good. Enjoy the rest of your day. Thank you guys for joining me today. We'll talk to you guys later. So long.